First of all, let's get your take on the market. We're seeing stability. It seems that's the story right now. Or are you still very cautious?
Well, I'll say cautiously optimistic. The reality is that the market is reacting to news. One of the things I've always said is that the key drivers of markets is information. And if there's no new information to drive investor sentiments, either positively or negatively, then the market tends to trade on a sideways basis. What we've seen is a situation whereby the numbers that have been coming out in terms of results across board. In the past, we had, the food and beverage sector, the breweries, the building materials providers providing the bright sparks. But now we're beginning to see some life, even in the banking sector. What is clear is that if we see good numbers from the rescued banks, none of them has reported third quarter numbers as yet. But if we see good numbers from that, then you could see a strong performance from the market for the last quarter of the year. But in terms of whether fundamentally anything has changed, I would say not yet.
And then let's look at some of those results. We'll focus more on the non-financials because obviously we've seen a flurry of results from the banks. But some that you could say have gone under the radar are Cadbury and Nestle. Let's start with Cadbury. Very positive growth story there. Over the last 2 years, we've seen some positivity. And this year, indeed, we've seen a return to profits.
Yeah. I think the story of Cadbury is basically how best to run a company. One of the key things that Cadbury has probably taught us is the effectiveness of a board. Cadbury has reduced his board members from 13 to 6, which means that decision-making is more efficient, decision-making is more streamlined. And that is quite a lesson for most of our institutions. Some of the institutions have 15, upward of 15 board members, upward of 10 board members. It is inefficient. What Cadbury has been able to do is to streamline its business, to take out all the excess fat that the company had to deal with in the past. And the trajectory for that company is definitely positive. There's also the possibility for a Cadbury, for example, to start now to leverage on the international brand. Which is products that are in the international market that don't necessarily form part of the portfolio in Nigeria. That for us it's quite a major market. I don't think that Cadbury uses effectively, for example, the cocoa production that we have in Nigeria in developing chocolate products, which Nigerians really love. But there's obviously an opportunity for companies like Cadbury to continue to show strong growth. With the sort of management that Cadbury has today, that has proven itself within a very short period of time, they've been able to attract capital to be able to reduce their leverage position. That obviously means that the company can be more efficiently run. EBITDA numbers become stronger, profit after tax numbers actually become even stronger because you're not spending all of your money servicing bank loans. So I think Cadbury's story is that of a strong recovery. I think that Cadbury will continue to trade strongly going forward. And that is going to be driven more by the quality of management and the ability of Cadbury to continue to compete with smaller players.
Right, let's just quickly touch on Nestle as well. I mean, they have a massive factory that they're building in Shagamu. I think that says a lot about where they see the potential they see in this market. But how are you rating that stock? Obviously, the most expensive stock in the market right now.
Yeah, from a price point of view, it's got the highest price point. Look, I think the story of Nestle is an interesting one. The way we've got to look at Nestle is a growth stock that has defied some of the basic principles of valuation, which means if you pay out all your profits, it means you're getting to saturation stage. But Nestle continues to pay out all its profits as dividends to shareholders, but still is able to fund its growth. And that's quite remarkable. It shows that it's a cash business, and its ability to generate cash is allowing it to fund its operations and also fund expansion. From the numbers that we have, the new plant in Shagamu is supposed to be twice the size of the Agbara plant, which means that Nestle is able to all of a sudden double production or even triple production. I believe that there are also plans to introduce products that are not currently in their product portfolio. And that's key for a food and beverage company. You've got to be able to ensure that in a systematic way, you're able to expand your product portfolio and ensure that the market is able to see that growth.
But does that justify this, what many are calling fairly rich valuation?
It probably does. And I think, look, the story with a Nestle is basically a flight to safety. That's generally what happens in a recession. The market focuses on companies that are able to continue to generate good numbers in spite of the fact that there's a weakness in the underlying economy. So the defensive stocks will always do very well. Do I think that there's significant room for a Nestle to grow from current price ranges? I'd say maybe another 10% headroom on the upside for Nestle. But I don't think that they're going to see Nestle return another 70-80% like it's done year to date, about 70% year to date.
It's clearly showed its defensive quality this year.
Yeah, absolutely.
It's up 60% already.
It's a defensive stock, and we knew that those defensive stocks were to play in 2010 and probably the early parts of 2011.